Hello again. Welcome to the webinar on the journey towards digital insurance from strategy to implementation. The webinar is hosted by the ILO's Impact Insurance Facility in partnership with AFD, the French Development Agency, and Financial Sector Deepening Africa, FSDA. My name is Aparna Dalal from the ILO's Impact Insurance Facility, and I will moderate the webinar today. The webinar will run for 60 minutes. We have reserved some time at the end for questions, so please do use the questions box that you see in your control panel to post any questions that you may have as the panelists are speaking, and we will try to answer as many as we can during the webinar. The link to the slides and the recording for the webinar will be emailed to you after the webinar, so you can be rest assured that you will have those. And at the end of the webinar, as you leave you will get a short survey. So please do take a few minutes to answer the questions, because your responses will help us plan future webinars. So today's webinar is on quite a timely topic. It will showcase the experience of two organizations that are going through a digitization journey. First, we will hear from Indira Gopalakrishna, who is the ILO's Impact Insurance Fellow and the Digital and Innovation Lead at Equity Insurance Agency in Kenya. So Equity Insurance Agency is an insurance intermediary that is in the process of digitizing its entire suite of offerings for micro and emerging customers, and is using a slew of new digital channels to reach these customers. Indira will talk about Equity Insurance Agency's digitization strategy and their implementation journey. She will talk about new solutions that they are offering to the micro and emerging customers, and also discuss and present some key decisions that they had to make during this journey, which would be, I think, useful for other organizations that are planning to embark on such a journey or are already in the process of digitizing. Next, we will hear from Jeremy Leach, who is the founder and CEO of Inclusivity Solutions, an Insurtech firm based in South Africa that is partnering with Equity Insurance Agency as well as other insurance providers to offer digital insurance solutions. Jeremy will bring an Insurtech's perspective to this conversation, which is crucial as Insurtechs form an important piece of the puzzle for digitization for impact insurance or inclusive insurance. Inclusivity Solutions is working with insurers and banks to offer inclusive digital insurance and Jeremy will showcase some new solutions that they are piloting right now. So as we think about this digitization process, it holds a lot of promise. So for an insurance provider, the reason to embark on this digital journey can include a number of reasons. There might be a need to reduce expenses. There might be a desire to more accurately and efficiently assess risk, provide better customer service, be more proactive in decision making, such as perhaps during the claims adjudication process, offer a new suite of products using alternative data perhaps on customers that was previously not available, or perhaps to improve profitability through better fraud protection. So digitizing operations or offering new products through digital channels holds a lot of promise. But while the promise is exciting, it is important to pay attention to some factors, and we will hopefully touch on these during this webinar. So first is, how do you digitize? Is your digitization strategy rather accepted by staff and clients, or whether the new solutions are inclusive? And this is especially important, when we are dealing with the micro and emerging customers. And then finally, making sure that customers' data and privacy is adequately protected as we go through this journey. Digital transformation may require a fundamental change in how innovation is managed, and perhaps a renewed focus on the customer experience, as many more possibilities are available now in terms of how you access and talk to customers. And also, I think there is a need for establishment of new business models, such as partnerships with Insurtech firms. So a number of questions face insurance providers as they go through this journey, and we will try to explore some of these in this webinar. Questions like, why digitize? Are we trying to reach new clients, lower costs, improve service, or compete with disruptors? What should we do first? Should we focus on improving operations, or should we offer new products through digital channels? How should we digitize? Is it better to build these solutions in-house, or to look for partners who already offer some solutions that we could adapt? And then finally, how to manage the entire process in terms of what's the appropriate governance within the organization? Do we have adequate leadership, or can we secure talent? And finally, can we anchor this digitization strategy within our culture? So there are quite a few questions here, and I hope that we can touch on at least some of them during this webinar. So now I would like to invite Indira to talk us through the journey and lessons from Equity Insurance Agency's digital journey so far. So Indira, over to you.
Thank you so much, Aparna. Hello, everybody. Over the next 15 odd minutes, I would like to share my experiences in digitalizing insurance at Equity Insurance Agency in Kenya. I have been working on this project since last April. So it's been about 16 months now. Sorry, I'm just trying to move my slides. While Aparna helps me out with that, maybe I can start by giving you a context of who we are and what we do. Equity Insurance Agency, or EIA, is an insurance brokerage subsidiary of the Equity Group. The group operates in 6 East African countries and has over 12 million customers, and we are headquartered in Nairobi, Kenya. Now, the group has taken the strategic direction of bringing full mobility to financial services. And in order to achieve this, we are executing what we are calling the Equity 3.0 strategy at the group level to leverage technology and use digitization to achieve a convergence of financial products and services. And we also want to use this opportunity to seamlessly integrate our many distribution channels. And this is what has set the stage for going digital at EIA.
So Indira, you can just let us know when you want to move the slide. It's fine.
Sure. Yes. So if you can move to the next slide. We began this exercise by identifying our desired future. And for us, the desired future was to be able to offer all our products and services across all the digital touch points in order to create value for customers while simultaneously driving profitable growth for the company. We did this by identifying 9 elements that would form the building blocks of this digital strategy. For example, we wanted to have everything online. We wanted to be mobile first because that was the group strategy. Given that we were primarily a bank, we wanted our transactions to be very safe and secure. Given the background of insurance being a complex product, we wanted to ensure that when we went digital, we wanted the applications to be very easy to use. From the experience that we've had currently, where customers feel that they wait too long to get their claims and so on, we wanted to be able to provide instant responses to customers while going paperless. And the other objectives that we wanted to fulfill was to be able to use third-party data and use pre-populated information to be able to save time and also give customers a wow experience. And at some point in the future, hopefully use big data as well. So moving on to the next slide, I'd like to talk about what was the driving force behind this. Now, while it was a group level initiative and that provided the impetus for us to go digital, there was actually an urgency that was brought about by the fact that the bank itself is far ahead in their digital journey. So amongst the subsidiaries, some of them were far ahead, whereas insurance was lagging behind. Now, this created some challenges over the last couple of years that made it very urgent for us to embark on our digital journey. The first one was that banking has actually moved away from our bank halls. Less than 20% of all banking transactions today in Equity Bank happen in a bank branch. So 80% of our customers either self-serve using their mobile, or they go to an Equity Bank agent, which is a mom and pop store and can be found every 15 feet away in Kenya. What this did is that it's made it harder and more expensive for us to find and reach customers to sell insurance to. The other driving force has been customer feedback about the experience being broken. So for a customer, they treat equity as one entity. So they do not understand why they can deposit money, withdraw money, even take loans using their mobile, but they have to walk into a bank branch to even buy a small ticket size personal accident cover or a mandatory motor cover. So this feedback that we've been getting for a while has been the driving force for us to kind of embark on this digital journey as well. Moving on. So our journey began by asking three very fundamental questions. So we can move to the next slide. The questions we asked ourselves were, why do we want to digitize? Do we want to increase revenues, or do we want to reduce cost? What is our primary motive? The second question we wanted to answer was, what do we want to digitize? Are we looking at digitizing sales, or do we want to digitize processes? Now, this was not a this or that question. It was more about what do we want to focus on to begin with, because we couldn't do everything at one go. And hence we had to decide what made most sense as a first step towards digitization. The third question that we asked ourselves was, how do we want to go about digitization? Do we want to build solutions in-house, or do we want to buy a ready solution, or do we want to partner? And we felt that it was very critical for us to answer these questions and be aligned on these at an organizational level as well as a group level before we started the implementation. So moving on to the next slides, we first tried to answer the why and the what, which were correlated. We realized that essentially to increase revenues, we had to digitize sales, or we could reduce costs by digitizing processes. We used 4 parameters to decide which one we wanted to focus on first. The first parameter that we used was visibility. We asked ourselves which of these 2 options would create a mind space with customers. And the answer was sales, because it was a customer-facing initiative, whereas processes were mostly internal. The second parameter we looked at was which of these 2 can we turn around at the quickest? And again, here the answer was sales, because the bank already has digital platforms that we could leverage. Whereas in order to digitize processes, since we are an insurance broker, we have dependencies on insurers, and we couldn't digitize processes at our end without coordinating with them. The third and the fourth questions were, what would give us a competitive advantage in the market, and what would create the highest impact? So digitizing sales seemed to come out better than digitizing processes across all the parameters, especially because we are a broker and sales is what we do. So we decided to focus on digitizing sales to start with. Moving on, the next question that we tried to answer was, how do we want to go about this journey? So we looked at each of our 3 options. The first option was to build the solution in-house. And each of these options had their pros and cons. So we realized that we have the capability to build these solutions in-house, because at a group level, we have a fintech team which has built the bank's mobile banking app and so on. But what we also quickly realized is that they or us do not really have the expertise to build an Insurtech app, which, while it still sounds like a financial service tool, is very different from building a banking app. The other thing we also realized was that building would be time consuming, and insurance, as an insurance subsidiary, would be put back in queue, and we'd have to wait for a lot of other group projects to be done before ours would get picked up. So that made building it a bit of an unattractive proposition. The second option was to buy. And this has been an approach that has been favored traditionally by equity, because that gives us complete control over the solution. In our case, though, we realized that since Insurtech is such a nascent stage, with so much happening in the space, so many new companies coming up, trying new things, new models, we realized that buying a solution right now might be a bit premature, and it would stop us from experimenting and trying out new models. It would also have a high exit barrier because it would have had high costs. So we moved on to looking at the third option, which was to partner. Now, this had probably the highest number of pros amongst the options, because we realized that it would allow us to go to market really quickly, because a lot of Insurtech players in the market had white labeled or ready solutions that we could kind of plug and play. Of course, it's easier said than done, but it's still quicker. It also has a low exit barrier, because these partnerships may not be more than 2 or 3 year partnerships, or it could be shorter depending on how well they go. The third good thing about partnering was that we could partner with multiple Insurtechs at the same time and try out different things and see what works for us as a group. What we wanted to be very careful about while partnering was to watch out for a culture clash. That's because Equity is a traditional company. We're a traditional insurance brokerage firm, and most of the partners are new age, agile Insurtechs. So we wanted to really ensure that there was a meeting of minds in this partnership, and everyone was aligned as to why we were partnering together. The other important thing we wanted to ensure was the clarity on roles and responsibilities, because unlike building or buying, here we'd be sharing control with an external entity, and Equity doesn't have a huge track record doing that, so we wanted to be very careful around this. So we realized amongst these three options that partnering would be our best approach for now, at least, and that's what we decided to go with. So that's how we decided on the what, why, and the how. Now, once we had answered these three basic questions, we moved on to the next question, which is to decide which are our key digital pillars. Now, as a group, we had 6 digital pillars that had been identified. But since we are a small subsidiary with just around 35 people in the corporate office, we decided that we would have to look at a subset of these initially to be able to focus and get some momentum. So we decided on 3 focus areas. The first one was to enhance customer experiences using digital. The second one focused on distribution, and it was to build an omni-channel sales model in order to move away from our dependence on bank branches. The third pillar that we decided to focus on was optimizing operations. While we had decided early on that operations would be tougher, we still wanted to do some groundwork here to understand the challenges better and to be able to help us at a later stage to decide how we would want to go about digitizing operations. Moving on. So once we decided on these 3 focus areas, we further broke them down into the first step, which would be a minimum viable product, and the end state. So in the first pillar, which was enhancing customer experiences through digital, the MVP that we decided on was to build an online sales portal, whereas the end state would be to extend this online portal to allow servicing as well as claims. Moving to the second pillar, we said that in order to build an omni-channel distribution model, we would first focus on launching one mobile microinsurance product, which is what we did with Inclusivity as a partner. And as a future state, we would move on to leveraging the other channels that the bank has, which are currently not being used to sell insurance. In the third pillar, we decided to first look at enabling a digital assessor for motor insurance claims to reduce TAT's turnaround times and fraud, because that is our biggest issue today. And at a future state, we would like to digitize all underwriting as well as claims processes. So having decided on the focus areas and the MVPs, we then moved on to the implementation stage. Now, because we were comfortable as a company as to where we were headed, and there was complete alignment from management towards along all the way till the working teams on what we were trying to achieve and how. So I'd like to give a brief overview of the 3 projects that we have embarked on. The first one was to build the online sales portal. Now, we are building a web portal and a mobile app, which would sit within our banking app, which already has over 500,000 users. This would help us get over the issue of customers not downloading insurance apps because they rarely use it. The online portal essentially has 2 elements. The first one is buy online, which would allow customers to buy insurance online by themselves in the comfort of their homes. The other option is sell online. This would allow all our sales channels to sell insurance using their mobile phones or computers. And in order to achieve this, we are partnering with a Kenyan Insurtech. The reason why we're doing this is fairly simple, because group strategy is to go mobile first, and that's where banking already is. And this is also a potential cost saving avenue, as well as we look at additional revenues coming in through this portal. Moving on, I'd like to show you a very simple customer journey. So this is what the customer journey looks like. You can go online. There's nothing new about this. This is very similar to what most insurers have already built. The difference is that we're trying to have an app wherein a sale can be completed in less than 2 minutes, at least for the simple products like motor and personal accident. So in order to achieve this, the Insurtech that we are working with has some tie-ups which help to pre-populate most of the information if you just plug in the vehicle registration number. So this is just an example on how we're trying to do some tweaks in order to ensure that the online portal is relevant to the lower income and the emerging consumers. And it can also be used by our 35,000 plus banking agents who may or may not be even educated, but are fantastic small and medium entrepreneurs. So we want to make it very simple and intuitive for these people to use our app. Moving on, I'd like to share a couple of learnings that we've had on this project. We are a couple of months, hopefully, from launch. And some of the main learnings that we've had is on integration. We realized early on that the partner, the Insurtech, had a white labeled app, which they could, they could let us use it within 3 weeks. We could go live, but integration was a challenge. Now we realized that unless you integrate it with the backend core system, we would not be able to provide a seamless digital experience to the customers. The digital journey would be kind of broken. Now, however, since most insurance core systems are legacy systems, the systems don't really want to talk to any new age systems, or at least the teams also don't. So that's a big challenge that we are trying to overcome in getting these systems to talk to each other. The second interesting learning we had very early on was all our sales guys assuming that they would become redundant as soon as this online portal went live. And this has been an experience in the past for me, as well as from others that I've heard of, where anything online is considered as a demise of the online channel. And the way we averted this was by talking about the sell online version of the digital platform that would help them sell, not just sitting in a bank branch and waiting for a customer to walk in, but they would be able to go out there, meet customers, and close sales right in front of the customers. So that was the methodology we kind of adopted to be able to give them the confidence that this was not in conflict with their jobs. The third learning, which could be only for equity or maybe relevant for others, is the commercials for us has been a key point of failure in partnerships in the past, where a lot of work would happen and then the commercials would not be agreed on, and then the partnership would fall apart. So this time over, we ensured that the commercials was nailed down, and we had sign-offs from all the business heads on the commercials before the work began. However, because a lot of all our projects are now multi-partner projects, contracting takes a lot of time. Also, given that we are a bank and we have our own safety and security concerns about contracting and regulatory concerns, in the past, work would only begin after a contract got signed, and that could take many months. So in this case, what we decided was to nail down the commercials, which used to be the biggest part of the contract that would go wrong, and start work after signing an LOI, a letter of intent, without really waiting for the contract to be signed. So the contract, in fact, has still not been signed as I talk about this, and we've been working on this for a couple of months already. So these have been some of the key learnings on this project. Moving on. The other project that we have launched was on the mobile micro insurance. And this one is a four-way partnership with Equity Insurance Agency being the insurance brokerage, Equitel, which is Equity Group's virtual mobile network operator being the MNO, Britam being the insurer, and Inclusivity being our Insurtech partner, who came together to deliver a health mobile micro insurance product to Equitel customers. Jeremy is going to talk about this in more detail, but just to give a brief overview as to why we wanted to do it as Equity, again, we wanted it to be on the mobile. So this was the first insurance product that we offered on the mobile on just a feature phone. So all the transactions from marketing to registration to buying the policy, paying the premiums, and even making claims could be done on a feature phone or a smartphone. It was also a new revenue generator for the Equity Group. And for Equitel, there were interesting additional adjacent benefits via increased average revenue per user, as well as loyalty to customers, from customers. Now, the way we went about this again, we followed, if you notice, there's been a trend where we've broken every project into kind of smaller MVPs to prove concepts. So in this one, we started with a 3-month pilot where we offered it to about 900,000 Equitel customers to start with. And that was the time when we ironed out all our tech issues, our marketing, our language, our contact center, and so on. And once we were comfortable, we then opened it up to about 3 million Equitel customers. And in the third phase that we're looking at now, we are trying to move to offering this product across all mobile network operators. So you don't need to be an Equitel customer, but you just need to be an Equity Bank customer. So we are now looking at moving this to about 12 million plus customers. So that's briefly about this project. Moving on to the last one, the digital assessor for optimizing claims. Now, this is essentially a mobile application that allows assessors to capture and update motor insurance assessments in real time. Now, the reason why we are very interested in this as Equity is because motor insurance forms a big chunk of our business, and assessment at claim stage is one of the biggest issues that we face from insurers as well as from customers. The turnaround times are very high, and there's also collusion related frauds between the assessors and the customers, which is why we're interested in solving this problem using technology. And the solution that we identified was a product called Malcolm, which is again an inclusivity solution product, which is a mobile assessment app. We are in the process of convincing our insurance partners to adopt this in order to reduce the turnaround times of our motor claims. And I think Jeremy is going to speak about this in some more detail as well. So that really brings me to the end of my 2 bits. So over to you, Aparna.
Great, thank you, Indira. Maybe I can ask you one quick question before I invite Jeremy. And it's probably better for you to answer this before he speaks, since he's one of your partners. So the question is from Stuart, and he's asking is, in your partnerships, would you ask for exclusivity with partners, or are you building multiple partnerships at the same time?
Okay, good question. The answer is yes and no. In case of the online portal, the partner is already offering that as a white label solution to other players in the market. So we are happy to not have exclusivity on that one. With inclusivity, I think we've had some elements where we've asked for exclusivity for a limited period of time. So it's really on a case-on-case basis. And as Equity, we are fairly confident of our distribution strength. So, which is why in the case of the online portal, we know that our distribution strength of 35,000 bank agents, as well as our 150 bank assurance agents, are what are going to make the solution successful, which is why we are not as concerned about exclusivity on that one.
Okay, great. Thank you. So now I would like to invite Jeremy to share his perspective on this digitization journey that a lot of insurers are taking, because he comes from the perspective, he brings the perspective of an Insurtech, and we are seeing that actually more and more insurers are looking to partner with Insurtechs for either offering new types of channels or new products. So Jeremy, I'll hand it over to you now.
Wonderful, thank you. Now let me see whether I can get this device to change slides, or whether I need someone to drive it for me. Okay, looks like I can drive. Thank you. So thank you very much for the introduction, which is most appreciated. So again, we're basically looking to provide the perspective of an Insurtech business. So we, as you have some of the background, what Indira has been saying, we've launched with Equity Bank in Kenya through Equitel, their mobile virtual network operator. We launched with Airtel Tigo in Rwanda, and also Orange Côte d'Ivoire, which you'll see a bit more about in a minute. But let me first kind of say, one of the challenges of an Insurtech, and use this quote, which I think is very pertinent, from a book by Horowitz, who is probably one of the more famous venture capitalists in the market, where he says the hard thing isn't dreaming big. The hard thing is waking up in the middle of the night in a cold sweat when the dream turns into a nightmare. And I think at the beginning, you are obviously excited about the Insurtech world and startup with extremely kind of dynamic kind of team and fantastic clients. And that's, again, very positive. But one of the big challenges you'll see as you go forward is that your turnaround times are not necessarily the turnaround times of your partners. And that is often where that dream of a startup kind of business turns into a bit of a challenge. Well, there's not always like that, of course. But I'd certainly, for anybody in the startup world or in innovation, I would highly encourage them to look at their book, The Hard Thing About Hard Things, which sums up that experience extremely well. So what do we do on designing, building, and operating digital insurance? Well, as I mentioned, we basically launched with these three kind of partners, three partners in Africa, 2 in East Africa, and 1 in West Africa. Again, basically supporting from designing, building, and operating. And let me talk a bit about that in more detail. So firstly, if you look at the circle, this talks about what we do from an end-to-end, as an end-to-end provider, where we will work with an insurance company locally, and also typically a distribution partner to provide the brand and trust. And that the brand is obviously particularly critical in this market. A few years ago, there's a quote that kind of said that in microinsurance, distribution is king, and that still holds today, where trust in insurance is still incredibly low compared to other distribution partners. So we would typically work with a large hero brand, which is trusted in the market, and work with the insurer to build the operation. So we go from doing human-centered design to try and really understand their client base and their need. And why is that important? Well, in Tanzania, 2 mobile operators launched free funeral insurance in the market. And still in my consulting days, when we were doing some work in Tanzania, we found that clients were ringing them up and saying, "Why are you cursing us? Why are you wishing us dead?" Now that clearly is not good for their reputation or the experience of insurance as well from the customer base. So again, you really need to understand the cultural dynamics in the market and the needs of those customers. Otherwise, you really won't be delivering a valuable kind of proposition. So on that basis, we saw that health risks were the highest perceived need across Kenya and Rwanda, and to a certain extent in Côte d'Ivoire. So we've launched what's called hospital cash plans in those markets. And again, the HCD basically supports us in helping frame the product, the communication with the clients, and the general kind of customer engagement, to the extent of also asking what is their preferred payment mechanism in terms of whether it's airtime, whether it's kind of bank, whether it's mobile money, in terms of how they like to communicate, what types of SMSs, types of language, how would you describe the product? And that's been incredibly valuable. So we provide that kind of context and provide the product development and pricing. In our experience, and before we started Inclusivity, we found that most insurers would typically focus on the upper end of the market. So they typically would look at the 2 to 5% of the population, which is, I think, the penetration in most emerging markets in Africa and beyond, with some markets like South Africa and Zimbabwe seeing higher penetration of insurance products. So the insurers really didn't have a very clear understanding of pricing in this particular market. So Nigel Bowman from our team plays a strong role in helping guide that pricing with support from RGA, our reinsurance partner. And again, what we've also found is just the extreme lack of data in that market. So we use the approach called the ATS model, which is a very technical term to say the actuarial thumb-sucking model to define the kind of the pricing suitable for the market. And then obviously we revise that through experience. Then we support the marketing and distribution models to understand how best to engage with customers. So with equity, there's basically multiple approaches, from the SMS base through using their kind of branches, through using their agents on the ground to help enable a multi-touch model to help people build people's experience in that market. The platform we use also supports for the digital sales and administration process, from clients being able to sign up through USSD or kind of SMS. We are not a great fan of apps for insurance. Just we don't think anybody would use it. Even with the explosion of smartphones in the market, the smartphones either don't have much memory or capacity, which means it limits the number of apps that clients will use, probably to things like Facebook or WeChat, or maybe an equity banking app because they do their banking on it. And also data, cost of data is still a challenge. So clients, again, will not necessarily be using, well, I think it's highly unlikely they'll use an app for a standalone insurance product. But so, which is why we support USSD and SMS as the most widely used technology. It supports the administration, so clients can administer their policy, pay their products. And what's most interesting in Kenya with Equity is that despite Equity Bank being the largest retail bank, they actually asked us to also offer M-Pesa as a payment mechanism, as M-Pesa still dominates kind of 80% of the kind of the mobile money market in Kenya. So again, it allows flexible payment models and also to allow you to pay claims, again, receiving documentation through WhatsApp or kind of email, just to make it as simple as possible to manage those claims. And what's key there is across all our markets, because we have the end-to-end platform, we can monitor the performance of the insurer, because that's where the reputation of insurance gets such a bad rap. It's because of the slow payment, the slow speed of payment of claims. So it allows ourselves and, say, for example, Equity in Kenya to monitor the performance of the insurer in paying claims rapidly and in a fast way. And that's obviously key to building trust in our clients, trust of our clients. On that note, we also ensure that as soon as the claim is approved, it's paid directly into that account. And again, what's been interesting is our insurance partners are now wanting to use the platform for their other partners. But why we've been set up is it's really because unless you get this client experience and to a high level and really delight the customer, we won't get insurance to be really viable and available to the market at scale. And it's also the reason why RGA, a reinsurer, help fund us so we can support insurers in the market learn and deploy faster across the different markets. So that's our first channel around launching with large kind of aggregators. Our second channel is Malcolm, which is what Indira mentioned, which supports claims assessment. And the intention behind Malcolm is really to grow the asset insurance space in emerging markets. As many of you know, the penetration of asset insurance is tiny compared with life and health, certainly in the low-end market. And a big part of that is the issue in terms of understanding the risk and managing the risk of these type of policies. This is, of course, outside of compulsory motor insurance. So Malcolm was set up to lower the claims assessment costs. So Malcolm essentially allows a broker, such as Equity, as Indira mentioned, to be able to log a claim through the platform, log a claim assessment, so that any assessor in a geographical area can accept that assessment, be directed to the location, and then have a guided workflow to do the assessment and then upload the claim real time. So it means that you've sped up the process, you've got real-time data for kind of analytics, because so many of these models are paper-based, and a better understanding of what's happening. Because the alternative use case, which we've seen in Kenya, is the client will ring up a broker to lodge a claim. The broker will check whether the client is paid up. The broker will then contact the insurer. The insurer will check whether the client is paid up, and we've seen that can take 24 hours, unbelievably, to check whether the client is actually paid up before contacting an assessment firm. The assessment firm then needs to allocate the assessment to an assessor who's directed to the location and may or may not be available that day. So that whole process creates quite a broken chain, an opportunity for delays, and is often very, very paper-based, so there's no ability to kind of analyze around this. So again, Malcolm essentially almost Uberizing this process for property and for motor insurance, and potentially agriculture should lower the cost of claims as well, because we can also use alternative assessors. So one lender in South Africa, we're aiming to use the loan officers as assessors in the market, but to the same basis you could use retired teachers or other kind of alternative claims assessors in the market. So that's Malcolm, which will hopefully support that model, and it's currently in commercial pilot in Kenya, and we look to expand that across Kenya and to other markets as well. So let's do what I've been asked to do, is let's look at some of the issues we've seen in the market from the perspectives of an Insurtech, where we're hoping we can retain the dream and that it doesn't become the nightmare. But some of the challenges or hurdles that we faced is certainly sales cycles, how long it takes to talk to partners. And Indira has talked about that from the perspective of equity, and that's a big bank with serious kind of bargaining power. Again, from an Insurtech, we've been engaging with different mobile operators across the continent. I mean, one of them has taken over 2 years to go from basically a decision from an executive person to launch. And that's incredibly frustrating and difficult because it's also obviously burning capital during that time. And that doesn't talk about the challenge of once you've, basically of going through the first sales cycle is engaging the customer and then launching. So just a couple of examples that may be relevant. One, we have a SMS catalog which basically summarizes all the SMSs that we have to send. And in one case, it took 4 months to get that approval, and not even a comma was changed. We've also seen that just to change a USSD menu, just tweaking the words, has taken around 2 to 3 months just to get internal approval from a large kind of partner, just because of their internal bureaucracy. So that's serious challenges for those partners. Commercial terms, and again, I would support Indira, that's always very tricky and often is only finalized kind of at the end as we negotiate around what infrastructure you're putting in compared to the partner and who does what. And that can be incredibly difficult. Certainly at Malcolm, there's a whole discussion around how do you cost that model? Does it have require some upfront capital, or is it purely a pay-as-you-go kind of model? And that obviously has a different commercial strain on the partner. Other aspects is competing with paper. You may see that picture on the right-hand side. That is from an insurance company that we're engaging with on Malcolm. That's the overflow from their claims filing cabinet. So in that experience, the insurer told us that for them to retrieve an insurer file once it goes into archive will take one person an entire day to go and find that file for one client. It's hugely cumbersome and difficult. And the general process there is the client will ring up to lodge a claim. The assessor will, the claims manager or the claims clerk at the insurer will write that down on one piece of paper. They'll then input it into their computer, and then they'll write it in their paper file. So essentially having 3 steps to manage that, but it's difficult to shift existing behavior. But again, competing with paper is a major issue. The partner's technology. On multiple cases, we've found that the MNO mobile operator or partner has said, yes, they offer this technology, and it's only after you start integrating it that you find that it's not actually possible to be able to do this. So we have something called Flash SMS, which is a USSD, which pops up on your phone. In a couple of cases, we ask them up front, can you support this? And when you get ready to launch, they say, what is it? Or no, they don't support that. So we found that quite challenging. On our side in Rwanda, we also hit quite a challenge where the telecoms regulator prevents mobile data from leaving the country, which has required us to put our own server in the country instead of using Amazon Web Services, which is a cloud-based kind of service, where we find the client experience is far more positive and it's quicker to pretty much do everything. But the challenge in Rwanda is that MTN, a mobile operator, will find $8 million for hosting data in Uganda. So we certainly don't want to experience that challenge. So again, there are a number of technology challenges. Even if our platform is best of class, we still have to integrate with our partners' system. Regulation is exactly what I mentioned just now in terms of the data protection issues, which cause such challenge in Rwanda, and it's certainly impacting the quality of the service for ourselves and certainly for our end clients to have to deploy local servers. Established practices. Indira talks about the fraud in terms of of claims. Well, one of our big challenges with Malcolm is that there's often cozy relationships between the claims clerks or claims managers at an insurance company and these claims assessment firms that do the assessments, where the assessment firms often give inducements to the claims team at the insurer for getting referrals. So you have these backhanders happening, which means that if you move to Malcolm, where essentially the claim is allocated according to where the assessor is, whether the assessor is located near the risk address, whether the assessor has the right skills and experience and is available, you've suddenly taken away the ability for the insurer claims team to be able to extort or get these benefits, I guess you could call it, from the assessment firm. So again, you're seeing real challenges on that side. Consumer education is a huge issue. How do you educate consumers and help them understand products when there is when they access via digital means? It's also why we have to do products with no exclusions, and that's critical to ensure that customers can understand the product. You do not want to have products that have exclusions for hang gliding or other things when it's such a small part of the market. So again, education is critical. But again, they need to digitize and simplify digital products is going to be a key enabler of that. Data is a real challenge. So this is our, we do a bit of, I guess, machine learning data analytics to help us understand what customers are doing and how they're behaving. But again, accessing the right form of data on time continues to be a challenge, where in some places we're only provided limited data, which limits our ability to target customers. It limits our ability to engage with customers. So, for example, in one of our partners, we have a loyalty product at no cost to clients, where we're seeing a 91% increase in the use of airtime because of that product, because it's incentivizing use of airtime, and a 21% increase in transactions, which is significant. But we're getting that data in arrears, where ideally we would want to have that data real time, so we can remind clients that if you spend another X or transact another Y times this month, your insurance will be increased. And it allows a much more dynamic engagement with our clients, which again would improve the experience. So again, whilst we actually do have significant amounts of data, the issue is sometimes the quality and the timing. And we continue to look forward to build on that area to support our data analytics kind of team. So to conclude, as I mentioned, human-centered design offers tremendous value, but the challenge, it must be tempered by the needs versus wants, where what we're finding is that whilst ACD was very informative, we found when we actually launched quite a different experience. And there's a nice blog on our website that shows what clients want wasn't necessarily what they needed, where they wanted to use Tigo Cash in Rwanda to use mobile money. Actually, they needed to use airtime deduction because that's where they had their balance on their account. Technology is certainly an enabler, a key enabler, but not always the solution. We need to understand how technology can enable you to do a lot of things, make things efficient, but you still need to temper that with the reality and what clients actually need on the ground. And again, like the example of, great, an app is a wonderful idea, but it needs to be suitable for the clients. And don't underestimate the challenge of the sales cycle for an Insurtech. We are dealing with big corporates. It's huge. And one executive of a mobile operator who then left the mobile operator to a startup, remember him telling me that he feels everyone in a big corporate should be forced to work for a startup serving a corporate. So again, that's critical, because if you have that understanding from a big corporate, 3-4 months is not very long in their world, but for a startup, it is a big challenge. So you definitely need to be aware of that. And that's again reinforcing that last point. We can be extremely agile, turn things in a couple of hours, as in one case in terms of amending a USSD menu. But from the partner time, it took 4 months to get the approval in place. So 4 months approval process for a 2-month tweak, that's not great. So we need to understand how to be agile in working with the large corporate, and that needs their support and commitment. So thank you very much for your time.
Great, thank you, Jeremy. That was really fantastic to get that side of partnership. So maybe I can ask the first question to you, and then Indira can jump in. So this is from Susan. So a question is, with many partners available, how do you go about selecting who do you want to work with? So I think this is more to Indira in terms of how Equity selected their partners. But Jeremy, having been part of managing or leading an insurer's microinsurance business previously, and now starting in Insurtech. So what advice would you give insurers when they're trying to select an Insurtech to partner with?
From my side, both are being able to kind of holler, and I guess ourselves. Obviously, you need to look at the team and see how strong the team is and whether they're able to deliver on what they wanted to do. And certainly from a technology base, get them to demonstrate to you what their capabilities kind of are. And thirdly, I think linked to Indira's point, you do need to look at the culture of the partner and how they approach things. So actually, one of the interesting feedbacks from one of the project managers of Equity, who on the previous who previously was critiquing us for being too pushy in terms of driving things forward and not necessarily following the project management process, actually came up to us afterwards and said, actually, it's been a fantastic experience because you've been chasing us rather than us being chasing you. So you do want to choose partners who are proactive and engaged, because that means you're going to deliver to time. Because the reality in a big corporate, you are so caught up in various committee meetings and other projects that it's difficult to always be following up. So you need to find a partner which has that culture of delivery in order to be able to provide the trust that they can deliver on your side, and hopefully address some of the innovation which you may struggle to do in a big corporate environment.
Okay, thanks. Indira, would you like to add to that in terms of what factors did Equity look at?
Sure. I think I'd also type this answer, but what I was saying is that, because Insurtech is so nascent, what we realized as Equity was once you peel away the glitzy marketing pitch that everybody has, there are very few partners who are actually able to offer the depth of services that they promise or have already delivered. So that's what we used as the key parameter to decide on who to work with, which is also what Jeremy was mentioning. The other thing that we did, of course, was to kind of put all our partners up on a chart and do a pros and cons, and also look at them qualitatively as well as quantitatively. Qualitatively, we looked at the kind of culture, do we know the CEO or the manager before, and so on. And quantitatively, what are the costs, what are the timelines, and what is the support that they're willing to offer. So it was a fairly rational, we were able to take fairly rational calls on this one.
Okay, thanks. A second question is, I combined a couple of questions from Selena and Gerald. So the basic question is, as we digitize some of these access points, we're moving from a high touch model to a low touch model. And especially when you're talking about, say, micro or emerging customers, or when you're talking about older customers or men versus women. So are there dimensions in terms of, how do we make such products inclusive? Do you have any perspective on, potential like gender differences that you've seen with customers, or you've tried to approach one or try to make these products appeal to women as well? And then secondly, and then just related to that is on the, on the complaint resolution process or administration. So how are you keeping customers informed about products or policy changes and ensuring that there is adequate customer education for these low touch products? So maybe Jeremy, if you want to go first, and then Indira.
Great. Yeah, no, fantastic question. In terms of kind of gender, obviously in the human-centered design research, we both get the insights of both kind of genders to help understand their drivers, to make sure they are tailored to their needs. One of the biggest challenges we found is that often in some countries, the female are the one who is the one who would be the driver in terms of wanting the product, but sometimes the decision has been made by the man. And I guess, unfortunately, in this kind of day and age. So we are seeing that interesting dynamic of seeing how do we engage, allow for that almost that double sale. One of them basically being willing to make the decision, and then the second one is actually need to make the actual payment. So that's been more of a challenge for ourselves in terms of implementing issues, and sometimes explains our not taken up numbers because you have that differential. I don't think we fully managed to address that at this stage, but it's one of the design features we look at kind of going forward. So far we haven't launched any particular more say women-focused kind of products, although there's a number of products in the pipeline that address particularly needs around maternity or such like. Although I'd say so far all our products and our hospital cash plans supports maternity kind of payments related to maternity, either in hospital kind of for 3 days or more. So I guess one, the product is sensitive to gender. We don't have exclusions related to kind of maternity. Secondly, we need to know, we're thinking more around designing it to allow the differentiated decision making across the kind of the genders. And again, thirdly, we're obviously going to be looking at products that are maybe more suitable for the genders in the different markets. Around the low touch, high touch model, we try to support both channels. So we have a hybrid model that supports both digital and physical. So again, we have digital from kind of SMS, obviously the detail on the website, but also in terms of physical from leveraging the service centers and the kind of the agents on the ground, which allows the agents to use the digital mechanism to sign up. So agents can sign up by using USSD, which allows the clients to also get a better understanding of how the digital mechanism works.
Great, thank you. Indira, do you want to add anything?
Yeah, I think Jeremy's touched upon most of the points, but just want to mention that Equity is very aware of this particular issue of customers not really willing to or would not be ready to sit and self-serve from day one, and insurance could be a fairly complex product, which is why we're looking at a buy online version for our customers who are tech savvy, could be millennials or could be the slightly higher end of the spectrum who could buy for themselves. However, we are making all our products also available on the sell online version, which would allow our Equity bank agents, of which we have 35,000, to be able to sell insurance digitally. So we're really using digital as a technology and not really thrusting it upon all our customers. So we're using a hybrid model.
Okay, great. So the last question now, because we're actually over time. So quickly, Indira, can you talk a little bit about the experience with the mobile insurance product to date? And maybe Jeremy, you can add on afterwards. So specifically, which parameters did you choose in terms of how did you select which clients to pilot with? And also, if you have any any information that you would like to share around uptake of the product and any lessons around challenges or strategies that work well or didn't work.
Sure. So I think when we started the first pilot with about the 900,000 Equitel customers, we broke them into 3 groups. We took customers who were already eligible because this was a freemium product. We wanted to see how behavior would be driven by the free product, the loyalty product. So we took 1/3 of the customers who would already be eligible for the free product to see if their behavior changed at all. The other set of 1/3 of customers were customers who were very close to qualifying for the free product. For example, I would get a free product if I used 100 shillings or $1 of airtime in a month. So 1/3 of my customers had already used $1 a month. The other 1/3 were close to utilizing it, which was about, say, 80 cents or 90 cents. And we wanted to see if this particular category would push themselves to cross the $1 mark in order to get the free insurance. And the one-third rather was customers who were very far from qualifying. So we wanted to be able to see behavioral changes, and Jeremy can share more details of how we've already seen very big differences in both the airtime usage as well as mobile banking usage of customers who are registered for Riziki, which is the product, as compared to those who have not. So Jeremy, do you want to share some more stats on it?
Sure. So basically, across Kenya and Rwanda, I think we launched in those cases the freemium model, which is basically the free product, the loyalty product, and a premium model. So essentially, those kind of that type of structure, and the details are on the Riziki, on Equity website, and Ingaboka Cash on the Tiga Rwanda kind of website if you're interested. So across the two countries, there's around 290,000 customers across the two countries, which is reasonable. It would have obviously been nice to be a lot higher. And then and if you look at the objectives, one was to launch the loyalty customer across the base, and those loyalty customers, loyalty products are designed to drive the what we call adjacent benefits, which is increased use of airtime, which is obviously a key driver for a mobile operator. And secondly, to drive payments, which again is a key driver for a bank like Equity or Tigo Cash, which is the mobile money platform of the mobile operator. So when the loyalty registrations are reasonable, nice to be a lot higher. But in terms of adjacent benefits, that's a very positive impact. So in Kenya, we've seen a 91% increase in the use of airtime from the loyalty product, which is significant, and around a 21% increase in the number of transactions, which again is significant, particularly when you understand that Equitel was launched by Equity Bank in order to compete with M-Pesa. So they're obviously trying to drive customers from M-Pesa, which is the dominant platform on the Equitel platform. So when you're seeing those increases, that's extremely significant and quite exciting. And then the third, so it is launch loyalty, drive the adjacent benefits, and the next stage is obviously driving kind of paid products, where we still have a way to go. But again, it will follow obviously on the loyalty side. So we're excited to see where we can take that, and particularly when there's a launch with the 35,000 odd agents of Equity, which will help drive that kind of the client engagement.
Great. So on that exciting note, we will conclude the webinar. I would like to thank both the panelists for being so open with their experiences and sharing some, I think, key lessons that hopefully are useful for other organizations who are embarking on this journey. Please do take some time to complete the survey that you will see when you exit the webinar. This webinar is part of a series as we are celebrating 10 years of the Impact Insurance Facility in 2018, and we will have a few more webinars through the rest of the year. So do keep your eyes open for those announcements. Again, thank you everyone very much for joining, and have a good night, day, or afternoon, depending on where you are. Thank you.